Gentlemen, let's go to these considerations. Very interesting. All of you and a few others who are not here issued a kind of what they call a statement in terms of forecast, your outlook for this meeting. Pabina, let's start with you from Vetiva Capital. In summary, you folks believe that you anticipate a whole decision at the conclusion of the meeting today. You also expect the central bank to persist in efforts to reduce market interest rate through the auctions and OMO interventions to ease government borrowing costs. Talk to us on this.
Yes, if you look at how the market has, particularly the fixed income market has transpired over the last couple of weeks, you would notice that the government has been coming out and cutting off rates at much lower levels than where we had seen. If you look at some of the benchmark bonds, we've seen that the rates on those the yields on those have come off a little. So that is a signal towards the market that the central bank is intent on letting a lower exchange rate prevail. However, because of considerations with where we are as an economy at the moment, other factors we've talked about, inflation, FX, pressure from external, they may not want to go right ahead and cut the benchmark interest rate. But what the central bank is signaling is that we are willing to accommodate a much lower interest rate environment from its actions at the markets.
Thank you. The views from Chapel Hill, Denham. Tajuddin, where do you folks think this will go?
We think they will go interest rates, but we bear in mind the fact that 25% of the members of the committee at the last meeting voted for a 200 basis point cut. That speaks volume. And that suggests that today we might just see a surprise. So broadly speaking, we're expecting them to keep rates unchanged. Two, we think that there'll be more voices to loosen monetary policy by cutting interest rates. So it may not be cut this time, but we think more voices will join the 25%, that called for a 200 basis point cut the last meeting. The third consideration we've seen is what Pabina spoke to, which is the cut of interest rate on OMO instruments and also T-bills at the primary market auctions. That is, more to my mind, a preparation of the CBN, of the market, against like a rate cut at some point. So most likely it will not be cut this time, but November looks like, a certainty in terms of rate cuts. Considering that the economic indicators to consider might stabilize over that period, then there'll be a compelling case for a rate cut by then.
Robert, let's take that, put that in the basket. Tajuddin. Robert, you folks wrote a very lengthy pre-MPC statement, and I want us to speak to the macroeconomic side of things. It looks like almost at every meeting, the central bank, the policy committee speaks to the fiscal side of things, the need for stimulus. Last year, they were talking about the slow implementation of the budget. This July, they spoke about the slow implementation of the ERGP and why you need very strong fiscal stimulus. So let's leave the market a little bit and speak to the broader macroeconomy, where many folks begin to think that's where the engine is not revving up as quickly, with speed, and with so much money and attention that it requires.
Well, we think that, first of all, we also voted for the retention of MPR at 12%. So it's just that we have a slightly different view, which toes the line of reasoning of one of the committee members, who perhaps voted for the reduction of MPR at the last meeting. We would say that the central bank has, to some extent, been very proactive in terms of refiring the engine of growth within the economy. By the way, it may appear that interest rate is 14%, so there is tightening, so to speak. But if we go traditional and we look at the implications of tightening, in monetary economics, when you tighten, you're talking about reducing the volume of money in circulation. And as at the latest data, July data, money stock was still marginally up. It's much more higher at above 7% if I look at the narrow money. of course, which speaks volume. Most investors, we don't want to put their funds, in time deposits when they can get as high as 17, 18% in treasury bills. So, but it appears that the CBN has not left, even the fiscal side. We've seen a lot of stimulus, or a lot of agricultural stimulus program that the central bank is coming up with, and the latest that has been the talk of the town in terms of how much the CBN is financing the deficit of government. What one of the members of the committee called the CBN becoming a piggy bank. But the point is that the whole configuration of monetary policy as we speak demands that there should be consistency. So we cannot claim to be tightening when money supply growth is expanding, so to speak. But we've seen some retracing of steps, since the beginning of the year. So if you analyze money stock year to date, I'm talking about broad money, you're seeing gradual moderation, which was why I think one of the members voted for a reduction of MPR to about 12% to ensure consistency of policy, But by and large, we think the committee is on track, in terms of what they are doing at the moment. We perhaps slightly disagree that the central bank is guiding rates downward. We think it's a pure market condition, especially if you analyze the range of bids, the rate at which investors were asking, because I think the market perceives that interest rate is about to start retracing its steps downward. You've seen that there's been a lot of calm in the bonds market, the longer dated instruments. But very recently, we've seen a lot of attraction because it appears that the length of stay of a very high interest rate may not last for longer. So a lot of investors are beginning to position in longer term instruments to lock in the interest rate, So, but we believe that the committee, to a very large extent, may want to, stick to what they did at the last meeting, which is to retain MPR at 12%. Hoping that there will be some alignment between what the management of the CBN is doing and what the Monetary Policy Committee is recommending. Sorry, if I may throw in a statistic, if you see, recently, CRR has remained at 22.5% for a very long time, but the recent security stabilization security, which the CBN has been issuing, which in turn debits the banks, and it's been issued, I think the last one was issued at about 17%, the one that was issued earlier in the year. So what that means is that effectively the CRR of 22.5%, which the Monetary Policy Committee recommended, is no longer the case if the CBN can debit the account of banks directly and issue a stabilization security. So it means that we need to be consistent between what the management of the CBN is doing and what the monetary policy recommends. And that speaks volume as to why we see a lot of divergence between the monetary policy rate and what the market rate is saying. If I may say, last year, you remember that before the committee hiked MPR in July, market has already guided towards a somewhat higher interest rate. In our view, there was no need to really increase MPR at that time, but the committee did. But between then and now, we've not really seen a sort of movement that we've traditionally experienced between the MPR and market rates. MPR is somewhat just, I don't want to, I don't want to say redundant, but I mean,
some folks believe it's not really, it's not really effective. But of course, gentlemen, we will take the shot. The governor of the central bank has just walked into the briefing room as always, and of course sitting now with the other members of the committee. They're getting seated, and you can see live images from the Abuja, the headquarters of the Central Bank of Nigeria. The briefing should be getting started in another couple of minutes. So let's return for about 1 minute very quickly to we'll return to Abuja, where Ogo Okiti is hanging in there with us. Thank you very much, Dr. Okiti. Very quickly, for 1 minute, before we listen to the central bank governor, we're sure he's going to start in the next few minutes. In terms of the broader policy and the polity, in terms of insecurity, in terms of debt sustainability and what have you. Do you think the macroeconomic environment provides a bit of confidence and for the central bank, this committee today, to say, look, we need to support what we're seeing the federal government doing at the center in terms of reining in the Niger Delta, securing some peace in the Northeast, and of course, are trying to make sure that stimulus begin to creep in?
Yes and no, because it depends on where the support the MPC gives is directed. At the moment, all the support that the monetary policy environment gives actually goes to the government. So I think the government is already getting enough support in terms of credit. The only other thing that the government will want to have is a reduction in the rate so that it can borrow more at lower rates of interest. But I'm not sure how much more the central bank can do for the government. But for the private sector, in terms of growth in general, which is the engine of growth, I think we have to look beyond the rates at which, beyond MPR. We have to look at structural issues that ensure that, that just make banks, the capital market, and everybody feel more confident to borrow to the government, to give loans to the government, rather than borrow to the private sector. And I think that is very, very critical. But I'm not sure it's something that MPR or CRR would do. I think we need something more structural than those parameters.